Hello everyone, welcome to my channel. Today we would like to highlight a book titled Money and the Language of Psychology with the subheadings below, Lessons from Wealth, Greed, and Happiness. This book has the original English title, The Psychology of Money, published in September 2020, written by Morgan Housel. This book will teach us to make the right decisions about money and understand the current economic situation. It is not a difficult theoretical book to understand, but a practical book that is very useful for all of us. Most finance and investment books teach us formulas, principles, and indicators that help us make investment decisions. But the authors understand that these formulas are just dead formulas. You know, they know, everyone knows. What matters is the human mind. It's like a pilot's manual. You learn the theory of driving. Your opponent also learns the theory of flying, just like you. But what makes you win is your courage and determination. Housel likes a quote from the French writer Voltaire. History never repeats itself, only people make the same mistakes. This quote, when applied to the financial sector, especially investing, is very true. So the writer likes to find the mistakes and wrong decisions of people in the past and learn from them, use them as lessons, and share them with everyone. Below, we share 3 important points that the author wants to address in this book. 1. It is better to make a rational decision than to make a rash decision. 2. If you want to live a long life, you must know how to leave enough safety space. 3. The distribution of a person's wealth and money is based on the experiences he has gone through. Part 1. First, let's talk about a person. The winner of the Nobel Prize in Economics in 1990 named Harry Marx. Those interested in economics and finance must have heard of this man. He created a theory in the field of finance that he called the Big Bang Theory. We all know that investing is full of risks, but how were those risks measured? No one can measure them, but Harry Marx is the one who created the risk measurement unit that allows us to calculate them. His theory allows us to find a method that can have the lowest risk and the highest profit, which we can apply whether we invest in the stock market, bonds, products, or international currency trading, etc. If Harry Marx's theory is really useful, has he himself applied the theory, and what were the results? Apparently, people have asked Harry Marx this question. Harry Marx's answer is, I buy half bonds and half stocks. At this point, let's take a moment to explain what a stock is and what a bond is. For example, I started a company and I want to expand my business, but I lack capital. I have 2 ways to get capital to expand my business. One way is to borrow money from a bank. This is the way you all know. The second way is to list my company's shares to the public through the stock market, which is called an IPO. Everyone can buy and sell my company's shares on the stock market. My company's shares are called stocks. Buying and selling shares like this is risky, but if you make a profit, you can make a lot of profit. As for bonds, they are not much different from stocks, except that the issuer of these bonds is not a private company, but can be the government of a country. For example, if Cambodia needs a foreign loan of $1 billion to develop its country, Cambodia can also issue bonds to sell to its citizens with an interest rate of 5% per year. In simple terms, you lend the government money and receive interest like from a bank. Buying these bonds has lower risk, but the returns are not as high. What does Harry mean when he says that if you have money, you should buy half stocks and half bonds? It's not hard to understand. He explains, if I take all my money and buy stocks, when the stock price drops, I have no choice but to sell it or wait for it to go back up. And if it goes up and I don't buy it, I won't be happy. So my investment principle is to make sure I have the least regrets. Back to the first message the author wants to convey to us, what does it mean to want to be reasonable? It is a decision that is appropriate, makes you sleep well, is not greedy, and does not regret it. This is an easy word to say, but most stock players cannot do it because greed is human nature. Stock angel Warren Buffett at the Berkshire Hathaway annual shareholders meeting also said to all investors, "Even if I had to make a final decision, I would not trade excessive wealth for my good sleep." So, in investing, you cannot be greedy. You must know how much profit is reasonable for yourself. If you want more, you must be willing to face higher risks. Why don't you want to gain more? The reason is simple. Only when you know what is called contentment can you persist for a long time. It's like exercising to lose weight. If you work hard and don't eat every day, you will definitely lose weight, but it will also make you hard on yourself, and it will make you give up easily. So you have to do things in moderation and don't want to get too much results. Generally, fitness trainers tell you to eat enough food, don't deprive yourself, and don't have to work hard to exercise every day. You can train 3-4 days a week, and the rest of this is for rest. Or they allow you to betray yourself for one day, called cheat day, where you can sneak in a barbecue, a buffet, or eat whatever you want to eat. Don't put too much pressure on yourself. Doing this will allow you to persist for a long time and not give up easily. Good investors use investing as a hobby to earn money in their spare time, but they do not make it a career. It is very important to be able to endure for a long time. You cannot buy and sell only according to the market trend. Warren Buffett said that as long as you do not leave the table, you will not know whether you have won or lost. Similarly, if the stocks you buy are falling, as long as you do not sell them, you will not lose. On the other hand, if you keep investing recklessly, only wanting to make a profit but not knowing about the company you are buying, it will easily make you give up. For example, you buy shares of a company because you expect the stock to go up in price, but you don't understand the industry well and don't pay much attention to the market, operations, or information about the company. If the stock goes up, you can make some profit. At that time, you will be more confident in yourself, thinking that your judgment is right. In fact, it is just luck. And if you invest immediately and lose money, you will blame yourself for investing in an industry that you don't understand. But if you have done enough homework before buying, you have understood the industry, know how to look at financial statements, analyze the market, know the vision and products of the company. If you are happy to invest in it, even if the stock price sometimes drops a little, you will not feel confused because you trust the company, trust your decision. Even if you do not make a profit or lose a little, you will feel like you are doing something you love. And if you make a profit, your happiness will double. In the book The Investing Fathers that we have already summarized, Warren Buffett's son said, since he was a child, he used to see his father sitting and looking at the financial statements of dozens of companies a day to find companies that were undervalued and invest in them. Warren Buffett's original words say, "Every day I go looking for discarded cigarette butts to take one last puff." He has been doing this for more than 80 years, starting to invest when he was 11 years old. Now he is 94 years old. He never gets tired of this work. He works 6 days a week. For everyone, buying and selling stocks is a job, a business, but for Warren Buffett, it is his passion. So it is no wonder that he is nicknamed the Stock Angel. When people say, "do what you love," you might think it's a theory of success or just a word of encouragement. But if you can find your path and pay attention to it, you might be able to go the furthest. Part 2. The above is the first part that I want to show you that when it comes to money and investments, you must be content, absolutely not greedy, and know how much is enough to make you sleep well and endure for a long time. But why do we have to struggle? How can our efforts be meaningful? Here the author gives us 2 answers. First, perseverance can increase your investment success rate. Many people have applied this theory to their own purposes. Some study returns over a certain period of time, some study the length of time it takes to get a return. But there is one common reason that they have found. The longer the investment period, the greater the return on investment. In fact, studies have shown that in the U.S. stock market, a good investment strategy can earn you a 50% profit per day, and if you do it within a year, the profit percentage increases to 68%, and if you extend the time to 10 years, the profit percentage increases to 88%. That is, the longer the time, the higher the profit rate. In addition to the high percentage of returns, being able to endure for a long time like this makes your money in the stock market grow more, and the accumulated capital will show its potential. It is like planting a rubber tree. In the first year, you need to take care of it carefully, and after 7-8 years, it will start to bear fruit for you. By 30-40 years, the yield it gives you is greater. It is said that investing is like running a marathon. The one who finishes first and makes the most profit is not necessarily the winner, but the one who can endure the longest is definitely the one who will get the real benefits. Whether you are doing business, opening a company, or investing, before you start making a profit, you must first make sure that you can support yourself. Billionaire Michael Moritz, CEO of the famous venture capital investment firm Sequoia Capital, said in an interview, "What has allowed our company to continue operating today and be one of the leading investment firms in the world is finding every way to survive. Some companies are only successful for 5 to 10 years, but Sequoia Capital has been able to survive for 40 years without any problems." The interviewer asked him, "How did you manage to do that?" When asked about this, Warren Buffett said, "Charlie and I both knew in advance that one day we would have a huge fortune, but we were never eager. Rick Guerin is just as smart as we are, but he is too eager." At this point, this book sends us an important message. There is no benefit in this world worth risking everything to get it. In Warren Buffett's investment strategy, we also see clearly that he always keeps sufficient reserves in his company. In the beginning, he never borrowed money from banks to invest in high-risk projects, even though he knew that it could generate huge profits. For more than 80 years, it has been seen that every time there was a sign of an economic crisis, he would sell the assets he had in his hands and collect the cash. Obviously, like the 2008 global economic crisis, everyone was bankrupt and closed their doors, but Warren Buffett not only did not go bankrupt, but also used the money he had in his hands to collect assets at low prices, which could generate huge profits for his company's shareholders. What does his company do? Berkshire Hathaway is an investment company worth more than $1 trillion, which is $1,000 billion. Some of the major companies invested by Berkshire Hathaway include Apple, Coca-Cola, MasterCard, Amazon, and BYD, etc. You must understand that if you see an opportunity and don't dare to take the risk of reaching out and grabbing it, the opportunity will fly away. You know Warren Buffett's advice: there is always an opportunity. As long as you don't leave the table, you will still have an opportunity. Above is the second important content that the author wants to explain to us, which is to feed yourself first so that you can have the opportunity to share the dividends when you win. In addition, the author wants to explain to us another term, which is technically called margin of safety, a financial theory proposed by the father of investment, Benjamin Graham, who is Warren Buffett's teacher. What is the safety margin? For example, you think a company is worth $10, but its market price is $9. You haven't bought it yet, but a few days later it drops to $7. So the actual market price of $7 is compared to your valuation of $10, which is a gap of $3. This $3 is called the safety margin. Knowing how to leave enough safety margin here means leaving this gap as far as possible. If you apply it to the market, no matter how high you value a company, you should leave a safety margin of 40 to 50% before deciding to buy. The term safety margin is not only used in the financial sector, but also in our daily lives. For example, leaving enough time for a road trip so as not to be late for work. For example, you think it will take 30 minutes to get there, but at least leave 45 minutes, fearing traffic jams, etc. In driving, the safety margin is the distance between the front of your car and the rear of the car in front. Part 3. In the first part, we said that investing or doing anything should be content with what you get, just enough. And in the second part, we said that if you want to live long, you should know how to save enough for safety. Now we come to the last part, which says, the way a person allocates his wealth is based on habits or experiences he has gone through. How does this word explain it? Isn't it different from a child who didn't eat enough when he was little, but when he grew up, he liked to eat delicious things? A person who has been hurt in a relationship, betrayed and lied to, makes it difficult for him to trust his partner later. In the financial sector and the stock market, it's the same. If a person has never lost, when he loses once, he can't control himself until he drowns. But if a person first starts playing and loses an investment, it's easy to quickly cut back on losses. In 2006, 2 economists conducted a study and found that people's investment decisions are influenced by their past experiences, especially during adolescence, around the age of 20. It makes sense because this is the age when people start to manage their own wealth, start to have their own money, so their spending and investment habits at this stage affect their investment habits later in life. A person is born in a different era, has different experiences, lives in different societies, sometimes has different luck, and makes different investment decisions. Sometimes what makes sense to us may be a miracle to someone else. That is why when we look at someone else's investment decisions, they may seem crazy or foolish, but according to their context and experience, they are reasonable. For example, you will understand. A man spent $1 million to buy a stamp on an envelope that was one of only 2 in the world. After he won the bid, he tore it up in front of everyone. Everyone thought he was crazy, but then he took a stamp out of his pocket. Now it is the only stamp in the world, and its value is now $8 million. In short, in this section, the author wants to show us that our spending or investment habits are largely influenced by our experiences when we were young. People are the same. Countries are the same. If you have lived in countries with frequent earthquakes, such as Japan, Taiwan, etc., you will know how to protect yourself and be careful. If you have ever fallen into poverty, you will spend more carefully. In the late 1990s, after the Asian financial crisis, 8 Southeast Asian countries began to hold more reserves. Why? Because they were afraid that in the event of a financial crisis, they would not have the money to pay their civil servants and they would go bankrupt like Sri Lanka. The above is the main content extracted from the book Money and the Psychology of Money. Those who are interested in reading this book can search for this book and read it. The book is titled The Psychology of Money. Thank you all for listening. Congratulations, you've finished listening to another book.